Singapore's central bank is staying put on monetary policy, contrary to expectations that it would move to tighten for a sixth time to tame persistent elevated inflation. Now, that's as the central bank says that the current stance is enough to ensure prices stay stable in the medium term. Now, this comes amid concerns that the domestic economic slowdown could be deeper than anticipated. Heidi Ng with more.
Economists say the central bank's surprise move signals that the risk dynamics between growth and inflation have shifted.
For the past 1 to 2 years, the focus and the concern has been on inflation. But that has changed because inflation has peaked and that it actually has been moderating. The reason why inflation hasn't moderated as quickly as what most people would hope for is because Singapore introduced the GST hike in January.
With first quarter GDP growth looking to be slower than expected, the Monetary Authority of Singapore says economic expansion is projected to be below trend this year. At the same time, higher interest rates globally have affected investment and manufacturing. The impact is likely to worsen in the quarters ahead and may create a vicious cycle.
If, the growth outlook generally is going to be a little bit more cautious, then we could in turn see a little bit more belt tightening. So if companies start to restrain wage growth, for instance, that could spill over into basically consumer confidence. And if consumers start to tighten their belts in anticipation that the labor market outlook is not so good, then that in turn, of course, will contribute, to a further slowdown in terms of the growth trajectory.
Meantime, MES says core inflation will still remain high for the next few months as rising business costs feed through to consumer prices. And its previous moves to let the Sing dollar appreciate are still working through the economy.
When the MES paused on its exchange policy stance, it doesn't mean that the Sing dollar is going to depreciate because the stance is still upward sloping. That means the MES is still maintaining a gradual appreciation of the Sing dollar vis-a-vis a basket of currency.
The central bank expects core inflation to slow in the second half of the year before ending the year significantly lower. Analysts say Singapore is in good company with regional central banks that have also stood pat recently. They now expect MES to adopt a wait-and-see approach for its next scheduled meeting in October.